It is Friday, September 29th, 2023. This is the Gary Talks Money podcast. Let's get this show started. Welcome to the Gary Talks Money podcast. This is the very first episode, and I'm so excited to have you with me today. My name is Gary. Obviously, if you're listening to this show, then there's a very good chance that you already know who I am. If not, I want to take a second to introduce myself and talk a little bit about this show, if I could. So, a little bit about me. Obviously, I'm the host of this podcast, but I'm also the host of a YouTube channel called Gary Talks Money. On the channel, I talk all about all kinds of personal finance topics. Things like saving money when you're shopping in-store and online, how to get and stay out of credit card debt, how to avoid common online scams, ways to save money while you're at college, ways to save money on vacation, and so much more. My background is actually in marketing, and I've spent my career working in the financial services sector and now in the manufacturing industry. During my time working in banking, I actually got the idea to start a YouTube channel about my personal finance and saving money. That all started when I saw firsthand how much of a knowledge gap there is around personal finance, especially among young people and just common everyday Americans. So many people don't know the basics of personal finance and feel certain financial services are just unattainable, whether that be something like a checking account or a mortgage or even a retirement account. So something that you need to know. I don't have any formal financial training or qualifications. I didn't study finance in college. I haven't worked on the front lines of the retail banking industry. I'm just a financial literacy enthusiast, and I want to share tips about saving money and building wealth. So that's a little bit about me. Now let's talk a little bit about the show. What we're going to be talking about on Gary Talks Money, the podcast, we're going to be talking about personal finance topics, just like the ones that I discuss on my YouTube channel. We're also going to be talking about money-related news stories that tie into current events. I'm also going to answer some of your questions, either in the form of a voicemail or through email. And we'll also maybe even talk with some finance experts about topics that you're interested in. So another one of your questions might be, well, this is a brand new podcast. How long is the podcast going to be? How much time should I budget to listen to this thing? Ideally, I'd like to keep the podcast around 30 to 45 minutes long. It's really going to depend on how much we have to discuss, though, so that could fluctuate from day to day. And another thing that I want to mention is, since this is my very first podcast that I've ever done, I am dealing with a lot of new equipment. I'm dealing with a lot of new buttons and switches and options. So if something goes wrong during the course of this very first show, please bear with me because this is not something that I've ever done before. I've got a switcher here. I've got some screens over here. I got the camera in front of me. So a lot of different things to control. I got some audio clips that I'm going to be rolling later in the show. So if something does go wrong or go off the rails, then you'll know exactly what's going on because I am totally a novice and an amateur at this. So we're going to talk about several things on the show today. The very first thing that we're going to talk about is we're going to talk about whether credit card balance transfers are actually a good deal. The next thing that we're going to talk about is actually a current events topic. We're going to talk about the looming government shutdown. The next thing, another current events thing, is we're going to talk about the FTC's antitrust lawsuit against Amazon. And finally, we're going to finish the show off with your questions. We've got a couple of questions at the end of the show. So let's go ahead and jump right in. Before we do that, I want to mention that if you want to join the show, very, very easy to do that. You can call and leave a voicemail at 352-619-2393. Or if you'd rather, you can email a question to gary@garytalksmoney.com. Another good way to get in touch with me is to just drop a comment on the video below down in the comment section if you're actually watching on YouTube. There are a couple of different ways that you can get this show. The video version is available on my YouTube channel, Gary Talks Money. Or if you're listening, you can actually listen on pretty much any major podcasting app. We're on Spotify, Apple Podcasts, Google Podcasts, and all of the others. So several different ways that you can listen to us, several different ways that you can get your questions to us as well. So if you're interested in joining the show, 352-619-2393, or drop me an email, gary@garytalksmoney.com. Very first segment of the show, let's talk about whether credit card balance transfers are actually a good deal. So, the very first question is, what is a credit card balance transfer? I actually did a little bit of research myself. I've got a rough understanding of what it is, and I've actually done a couple of credit card balance transfers myself, but I wanted to look in to see what some smart people thought the best, most concise answer was. So I looked on NerdWallet. NerdWallet is a great resource. You can actually learn a lot about personal finance on NerdWallet, but NerdWallet's definition of a balance transfer is that a balance transfer is a type of credit card transaction in which debt is moved from one account to another. So basically, if you have a credit card that has, let's say, a $3,000 balance, and you move it to another credit card that has a low or a zero balance, typically people do balance transfers because they offer some kind of interest advantage. So the APR, or the annual percentage rate on that credit card that you're moving your debt to, is lower than the card that you currently have, or it's zero. In some cases, credit card companies offer promotional offers for you to transfer your balance from an existing credit card to a new credit card or a card that you already have. So are credit card balance transfers actually worth it for most people? Well, I want to talk a little bit about the pros and the cons of credit card balance transfers. Starting off with the pros, one of the pros is that you potentially have access to a lower interest rate by doing a balance transfer. Transferring balances to a lower interest rate card is going to reduce the cost of carrying that debt. So that's a big consideration. Another thing is, like I mentioned, a lot of credit cards will offer a 0% introductory APR. It's something to kind of get you interested in the card, something to get you to transfer a balance over and establish a relationship with that credit card company. Some credit card companies do offer an introductory, either low or no interest option for a certain amount of time. Now, you got to note, and we're going to talk about this later with the cons, you have to note that that introductory APR is just that. It's introductory. So the very first balance transfer that you do is going to be either low or no interest, but there is an expiration date on that. Typically, it's going to be around 12 to 24 months. It can be anywhere in that range. Some cards are 12 months, some cards are 18 months, but a lot of them are in that 12 to 24 month range. You might find a card that has an even more generous introductory offer. It could be as long as 36 months, I've seen, but generally you're going to see at somewhere in that 12 to 24 month range for the introductory APR. And what that means is during that period of time, you have the balance on that card, either 12 or 18 or 24 months, you are not going to be charged interest to have that debt on that credit card. Now, the other thing that is a pro, in my opinion, is how easy it is to budget. It's a little bit easier to have a fixed monthly payment with that 0% interest credit card. If you transfer multiple cards over into a balance transfer card, it is easier to budget having just one payment. You're also cutting down on the amount of interest that is accumulating on multiple cards if you put it on one 0% or even low interest card for that piece. So let's talk about cons, because there are a few cons attached with doing a credit card balance transfer. The number one con that I can think of is transfer fees. Generally speaking, these balance transfers are not free. They will offer you a 0% interest option, but there is going to usually be some kind of fee attached to it. It's usually a percentage. It can be a flat rate, but usually it would be your percentage. You're thinking anywhere between 2.5% to 5% is generally that range. And they're going to charge you to initiate that transaction. There's a couple of different ways that you can do it. They can either deposit cash directly into your bank account, and then you can go and pay off your cards that way, or they can work directly with the other creditor and transfer the balance from that card to the new card. Either way that you do it, it doesn't really matter, but that transfer service is going to cost something. So on top of any interest that you will pay after the introductory balance transfer offer expires, you're also going to be paying for that transfer fee. So you got to factor that in, and you got to realize that it will actually potentially reduce the amount of savings depending on how large the balance is that you're transferring and depending on how large the fee is that that credit card company charges. Another thing that we did mention is that these interest rates, these low rates are temporary. They're not permanent. They're not long lasting. And even though 12 or 24 months sounds like a long period of time, it goes by pretty quickly, especially if you're not making a priority of paying off that debt fast. So 0% APR rates are temporary and they often will increase exponentially at the end. Now, you won't be charged back interest. Generally speaking, you will not earn any interest during that period of time. However, as soon as that balance transfer offer expires, you are going to start accruing interest on the balance that's left on that credit card. So you do have to know whatever the normal transfer, I beg your pardon, whatever the normal fee is, whatever the normal APR is on the credit card, you got to be aware. So if it's 19.99% APR or 23.99% APR, whatever that is, it's going to go to that at the end of that period. The other thing is the credit score impact of opening a new credit card to do a balance transfer. Your credit score might actually dip a bit because you're opening up a new credit card. And, the difference is going to be negligible in your credit score if you're opening up a new card to do a balance transfer. And as long as you're paying on that card during the period of time that the balance transfer rate is active, I don't think you're going to see a major difference in your credit score. It's going to dip temporarily, but it should go back up at the end. As long as you keep those accounts open and in good standing, I don't think you're going to have much of an issue with it. So I'm interested in seeing what you guys think about the whole balance transfer process. Have you done it yourself? Do you recommend it? Did you save money? Definitely let me know. You can either leave a comment on this video if you're watching the video version, or you can definitely call in or shoot me an email and let me know. That's something that we can definitely talk about in further detail in a future show. All right, so we talked about a little bit of finance related stuff there. I want to move on to the news, and I want to talk about a segment that I like to call news that you need to know. So let's go ahead and jump right into that.
It's time for the news you need to know.
So as I mentioned, we are going to periodically cover stories, current events that are kind of finance related, or at least tangentially finance related. And the very first one that's kind of looming on the horizon that is very much money related is the government shutdown. If you've been following the news, you definitely know about the government shutdown, but I'm going to go ahead and play this clip and we'll talk a little bit more about it.
If the president wants to make sure that we can keep government funding and continue to work on the bills that the House has been working on a lot, the Senate hopefully starts taking them up, take an action on the border.
So that was House Speaker Kevin McCarthy speaking to reporters, talking about the potential of a government shutdown. And he was saying that basically there's going to be no spending deal reached in the House of Representatives without the president's action on the crisis at the southern border. Now, some hard-right Republicans in the House are actually using a threat of a government shutdown to force action on this border crisis. And it's kind of left Speaker McCarthy in a bit of an awkward position. A short-term bipartisan spending package has actually already cleared the Senate, and that kind of paved a way for a potential deal in the House of Representatives. However, Speaker McCarthy has refused to bring that measure to a vote because there are some hardline GOP members, like Florida Representative Matt Gaetz, that have threatened to oust McCarthy from his speakership if he allows a vote to move forward. So they're very, very serious about this. They want this border situation, which is very, very serious. They want this border situation addressed. They want some concessions made before they go forward with a vote on any kind of spending package. Now, what you need to know is that funding is set to expire at 12:01 a.m. on Sunday, October 1st. That's when the government's fiscal year is ending. Government funding is going to officially run out then, and that is when a government shutdown would begin. So, some things that would happen if a shutdown occurred, according to a CNBC article that I read. The very first thing that would happen is about 2 million civilian federal employees would be either furloughed or they would be forced to keep working without pay until the shutdown resolves. Now, federal employees are not really strangers to government shutdowns. There were 3 government shutdowns that happened during the Trump administration. There have been dozens of other shutdowns that have happened in the past, but essentially what happens during a government shutdown is most civilian employees, you're thinking people like that work at the post office, park rangers at the National Park Service, folks like that, they will either be furloughed or they will continue to work, and then they will be paid back pay once the shutdown is resolved. Now, that does put federal employees in kind of a tight spot because, they're not getting pay coming in during the time that the shutdown is happening, but they will get paid back eventually. What is another thing entirely are government contractors, people that work for the government on a contract or contingency basis. That's a little bit different. They may not make up lost income during this period of time, so the shutdown could actually be detrimental to government contractors. Another thing that will happen is that military personnel who are on active duty, that's about 1.3 million people, they're going to stay on the job without pay. Again, they're going to be getting their back pay when the shutdown ends, if it does indeed happen, but we're going to have military personnel on duty without pay. And then another thing that you might see is national parks, monuments, certain museums, they might be closed or have limited service during this period of time. Now, there's a ton of other things that would potentially happen during this shutdown. There's things like government benefits for veterans that would be curtailed during this period of time. There's also things like SNAP and WIC benefits that would be affected during this time period as well. Section 8 housing vouchers would be curtailed during any kind of government shutdown. So a shutdown is very wide reaching and far reaching in that regard. But just some things that you might look forward to and expect if a shutdown does indeed happen. Now, that would only happen if a stopgap spending measure is not approved before the expiration of funding is set to happen, which again is on 12:01 a.m. on Sunday the 1st. Now, reactions to this whole thing are a bit mixed across the spectrum. Some commenters have said that they support the possibility of a shutdown. Others have said that it seems kind of theatrical and stunty to do, to push for a certain initiative this way. One commenter on YouTube said that it doesn't matter. You still have to protect the borders, even if it means politicians lose their retirement packages. Another user says, yes, shut it down. And then you have another person that says, if you have to shut the government down to get what you want, maybe your idea isn't that great. So some varying points of view on this situation. Something to note is that the politicians who are in control of this entire situation would continue to get paid during any kind of government shutdown. Their staffers would not get paid, but for some reason, government officials, our elected officials, senators and representatives would continue to get paid during this period of time. So this story is certainly something to watch. If something hasn't changed already at the time of this podcast going out or doesn't change going forward, then we are definitely headed towards another government shutdown here very soon. Shifting gears, let's go ahead and talk about this FTC suit against Amazon.
So this lawsuit is fundamentally about protecting free and fair competition. And the U.S. antitrust laws prohibit firms from using their monopoly power to punish or preclude or prevent competition.
That clip was from FTC Chair Lina Khan on why the Federal Trade Commission has brought a major antitrust lawsuit against e-commerce giant Amazon. Now, that clip was from a CNBC interview that happened on Wednesday. On Tuesday, the FTC and 17 states actually sued Amazon, alleging a host of anti-competitive and unfair practices. Now, the FTC says that it has filed the lawsuit against Amazon because it is, quote unquote, illegally maintaining monopoly power. Now, according to the FTC, and I'm going to quote this, Amazon's ongoing pattern of illegal conduct blocks competition, allowing it to wield monopoly power to inflate prices, degrade quality, and stifle innovation for consumers and businesses. And that is a direct quote from the FTC's announcement of this lawsuit that went out on Wednesday. Essentially, what you need to know, the key points of this lawsuit are as follows. The FTC alleges that Amazon has stopped rivals and sellers from lowering prices. They say that Amazon has degraded quality for shoppers, that they have overcharged sellers, that they've stifled innovation, and that they've prevented rivals from fairly competing against Amazon. Now, one thing that is sort of unclear is what the enforcement mechanism or the punishment that this lawsuit is seeking. While the FTC says that, quote, they, along with its state partners, are seeking a permanent injunction in federal court that would prohibit Amazon from engaging in its unlawful conduct and pry loose Amazon's monopolistic control to restore competition, it's sort of unclear exactly what that injunction would entail. The FTC is not calling for a breakup of Amazon, and there's not really any mention of monetary fines being levied, so I'm not really sure what the injunction they are seeking would entail. Of course, there are some people that were sounding off in the comments section about this whole thing on the YouTube video that I pulled this clip from. One user says that I don't get the lawsuit. I've always cross-shopped Amazon with Walmart, Target, Costco, and Best Buy to make sure that I get the best deal. If the prices are the same or less on Amazon, then I shop there. Amazon delivery service is just miles ahead of others. Another user says that the contradictions of the alleged misdeeds are quite confusing. How can you say we are harmed by Amazon's policy to force sellers to quote unquote sell low on the site, but then also say we are harmed as Amazon is inflating prices? Seems like the lawsuit hinges on protecting sellers, not consumers, as she went on about Amazon's unfair cut of sales. Why not go after Google and Apple's App Store fees if the law is now there to protect suppliers? And then you've got a couple of other viewpoints. One person says that Amazon is great for consumers, and kind of a dissenting view on the subject. One person says that the FTC needs one major win against big tech. So obviously you can see that this is a complex issue. There's a lot going on here, and we're going to have to see how this lawsuit progresses. Amazon has pushed back, obviously, pretty vehemently that they've not broken the law, that they're not a monopoly. And whatever you think about the issue, I am curious to know. Definitely let me know down in the comments section or send me a message. I'm curious to see what your thoughts are on this issue and whether you're an Amazon shopper as well. All right, let's move on to another segment of the show where I will actually answer your finance questions. We're going to actually start with a question from Erika from Central Florida. Let me go ahead and roll this clip and we'll get into it.
Hi, Gary. This is Erika from Central Florida, and I have a question about travel credit cards. Can you tell me about their pros and cons? I know some of them have annual fees. Is it worth paying that? And is there a minimum amount you have to spend on them in order to get those bonuses that they offer? Thanks a lot. I'm looking forward to hearing your answer. Bye.
All right, that is actually a very good question. I have a little bit of experience with travel credit cards myself. In fact, I have one currently that I'm using a bit. I'm using it pretty regularly. I used it on a trip very recently, and I've actually gotten some bonus points from a card. So you brought up some good points about the annual fee, about pros and cons of having and using these cards, and then also the spend amounts. I think the first thing that I want to tackle is the annual fee. Some credit cards actually have really high annual fees. They can actually be in excess of $500 per year. Now, these are the top tier travel credit cards. These are going to be cards like the Amex Platinum card that has an annual fee of $695. Also, the Chase Sapphire Reserve card has an annual fee of $550. And the truth is, I don't actually recommend cards like these for your average traveler who makes maybe 1 to 2 trips per year for either leisure or vacation. While the benefits that are offered by these cards are often really, really good, there are things like lounge access and TSA pre-check credits, higher points earning rates. The annual fees are just not worth it for most people. And you're just not going to use these cards enough to outweigh the high fees that are attached to them. Now, if you are traveling a lot, either for business or for pleasure, they may actually be worth it. You just have to do the math and figure out whether you're going to break even on these cards and whether the benefits are things that you're going to actually use on a regular basis. What I recommend as an alternative to high annual fee cards like the Amex Platinum and the Chase Sapphire Reserve are the cards that are just a tier below them. These are going to be cards like the Chase Sapphire Preferred. Now, it is a step down from the Reserve card, and the annual fee is a lot lower at $95. But some people may still balk at the idea of paying to use a credit card. The thing is, I think the Preferred card is actually one of those rare cases where the fee might be worth it. New users can actually earn a 60,000 bonus point sign-on bonus when they spend at least $4,000 in the first 3 months. Now that translates to a $750 travel credit, and that can be redeemed through Chase's Ultimate Rewards portal. Now, you also get access to perks, things like travel insurance, rental car coverage, extended warranty protections, and more. These are things that a lot of your average run-of-the-mill no-fee credit cards just don't offer anymore. So there is a little bit of value attached to that. And there's a good chance that if you travel enough and you spend enough on these cards, that you're actually going to outweigh the annual fee. So if you spend enough and you earn enough points, then there's a good chance that you might cover the cost of the card with just points. If you also use the benefits like the rental car coverage and the trip cancellation protection, those alone are typically worth the annual fee in my experience. Now that brings us to the spend amounts. Most travel credit cards, kind of one of the drawbacks of travel credit cards is that most travel credit cards do require you to spend pretty large sums of money in order to unlock those sign-up bonuses. Now, those are usually anywhere between $1,000 and $4,000 within 3 to 6 months of opening the card. So that may not actually be feasible for a lot of people. My recommendation is if you're thinking about signing up for one of these cards, pick the card up before you have a major planned purchase. This could be something like a vacation or a cruise. You might be purchasing large appliances. You might have some kind of major repairs, or you could even consider prepaying for things like your homeowners or your car insurance. The thing is, these larger necessary purchases in a shorter period of time are actually going to help you reach that spend threshold without stretching your budget unnecessarily and straining yourself financially. So there are some pros and cons to using these travel cards, but if you shop around and you shop smart and you only sign up for travel credit cards that you know you'll use, I think you'll have a pretty good time, and there's a good chance that you'll make your money back. All right, question number 2 comes from Jane in Belleview. Jane asks, what investments do you recommend for someone that doesn't have a very high income, that has a small income? That's a great question. If you're someone that's living on a fixed income, or you're someone that just doesn't make very much money, then you might be looking for an opportunity to stow some money away and make a little bit of a return on that. My answer is probably not going to be super exciting. It's kind of a safe bet answer, but my number 1 and number 2 recommendations are either to open up a certificate of deposit or to put your money in a high yield savings account. Now, what is a certificate of deposit? Essentially, a CD is an account that you put your money into for a set period of time. It could be a few months, it could be a few years. The terms generally run from 3 months all the way up to 10 years in some cases, but there are increments in between. You could put your money in a 12-month CD or a 24-month CD. And what happens is the bank will actually pay you a higher rate of return than if you put your money into just a regular savings account or a checking account. And why can they do that? Well, they know that they're going to have that money on hand for a longer period of time that they can use for other purposes, either lending it out or reinvesting it. So they can pay you a higher rate knowing that you will keep your money in the account for that period of time. A high yield savings account is basically just a savings account that pays a high rate, a high APY, or high annual percentage yield. These are actually really, really good right now, and there are going to be really good rates on high yield savings accounts. We've seen high yield accounts ranging anywhere from 4.5% up to 5%, and sometimes even 5.5% interest right now because interest rates are so high. So You might want to take advantage of either a CD or a high yield savings account. You do potentially have the option of using government bonds or even a mutual fund if you would like to go that route. The only disadvantages with those is that they might require a little bit more investment than a CD or a high yield savings account. And generally, especially with government bonds, you're going to have a longer maturity date on those. So you're going to have to tie your money up for quite a while. Whereas a CD, you can pick the term that works for you. And a high yield savings account, you can just leave your money in there and there's no term attached to it. You can take it out whenever you want. Some people do even like physical assets, things like gold, silver, or collectibles. Those, the value is going to fluctuate on those. You can do your research and see what works for you, but those are definitely options as well. If you're not super high income and you're, dealing with a relatively small income, my recommendation would probably be to avoid the stock market or other riskier investments. And that's just because there's a higher chance that you could lose the principal that you've put in, especially if you don't know what you're doing and you're not a professional investor. I would just avoid the stock market entirely because there is more of a chance that you could lose the money that you worked hard to earn. All right, so we had two very good questions. We covered quite a bit of ground in this show. I hope that you enjoyed the show. Again, a reminder, if you would like to join us for a future show, you can definitely give us a call at 352-619-2393 or shoot me an email, Gary@GaryTalksMoney.com. Definitely, please send those questions in so that we can answer them on the show. I hope that you found the information that was in this show helpful. Please join us in a couple of weeks for episode number 2. Until then, guys, take care, and I'll see you later.